This company was celebrating record breaking sales, but 6 months later, they were cutting teams. Revenue was growing, customers were increasing, but profits were collapsing. Today, I will walk through a realistic profit margin case study and show how data analytics solved the problem. Hi, this is Rasmi. In this video, we are not discussing theory. We are deep diving into a realistic business problem using profit margin analysis, like analysts do in their real companies. By the end, you will see how one metric changes pricing, customer, operations, and strategy. Meet company Alpha Retail, a mid-sized e-commerce company. Business snapshots. Its industry is retail and e-commerce. Products, office supplies and furniture. Geography, it has multiple regions. The management was confused. Sales dashboard looked great, but cash flow was tightened. So the analytics team was asked one question: where is the money going? Where is actually the money going? The first thing we did was stop looking at the revenue and start tracking monthly profit margins. What we saw immediately was volatility. Margins range from 3% to 21%, no consistent upward trending, several sharp drops despite high sales months. This told us the problem wasn't demand, it was efficiency. That showed something brutal. Discounts above 30%, margins turning negative, sales volume increased, but profit collapsed. In simple words, they were buying revenue at the cost of profit. The business insight here you can get is using a sugar for short term it is good, but for long term it is not good for health. Now we are into most dangerous question. Should we keep all customers intact? Look at this table. It shows segment-wise distribution of total sales, total profit, profit margin percentage, sales share percentage, and profit share percentage. From this table, in the consumer segment, which is a volume driver and margin diluter, contributes over half of the total sales, generates less profit than its sales share, lowest margin among all segments. Corporate segment is balanced and stable. Profit share slightly exceeds sales share. Healthy mid range margin that is to 13%. Home office segment margin champion. Lowest sales share, highest profit margin. Profit contribution exceeds its sales contribution. So we can say that home office is the most efficient segment, small in size and high in value. So we can say that 20% of the customers are generating 80% profit while other 20% are destroying the values. Here is what company did next, purely based on margin insights. Cap discounts at 25%, shifted promotions to high margin products, limited same day shipping, focused marketing on profitable customer segments, paused expansion in low margin regions. Here, completely no guesswork, no opinions, only based on data the decisions were made. This is how companies need analysts to think, not just dashboards, but decision makers. If you need more case studies like this, then like the video, subscribe, and comment case study below. Thank you.